Welcome to Premium Cashflow Real Estate Investing Podcast with SK040. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, SK040, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, SK040.
Welcome to another edition of Premium Cashflow Podcast. Today I have the pleasure of hosting Ryan Gibson with Spartan Investment Group. The Spartan Investment Group invests in a lot of syndicated self-storage assets and a few other asset classes as well. And Ryan leads the investor relations and the all the capital raising aspect of their company. He is the CIO and the co-founder of their company. He has done several cycles of real estate, plus invested and done deals within whether it's ground up development, luxury rentals, and things like that. So welcome to the show. Thank you for taking time, Brian. I appreciate it.
Thanks for having me. Appreciate it.
Sure. Awesome. Give us a little background, Ryan, as to, how you came about in real estate and sort of now with the Spartan Investment Group of yours.
Yeah, so today we just operate a bit over 4,000 units of storage and RV parks. And my previous career was in aviation. I was an airline pilot and did airline management for a bit of time. And so not too far from where you're from.
Sure.
I lived in DC, and that's where we started our business, basically developing condos, converting those old DC row homes into condo projects and then flipping houses. So
I see.
Yeah.
So you intensely know what a renovation and a flipping the whole end-to-end cycle is like. And as you mentioned, you have done a lot of projects in Washington, D.C., and I'm kind of based in the sister city in Columbia, Ellicott City in Maryland. So we kind of always have that sort of a perspective on what's happening in the market, and we look at different markets as well. So Ryan, explain us that now you kind of went, I call it like a full cycle or a diverse cycle of sorts, that you started from residential flipping houses and, sort of seeing that lens. And now with your company, you all have graduated into, let's say, the storage, self-storages and the RV parks or the manufactured housing and things like that, right? Give us an overview of why that, or perhaps not the typical multifamily draw that a lot of investors get drawn into.
Yeah, sure. First and foremost, it was the economics. The last two recessions, storage did the best. So we were looking at high performing asset classes during times of recession, which at the time we were looking at, potentially the next recession and what performers would be standout. And that was storage. The other thing that we liked is that, you put a lien against people's stuff. So you have collateral against the tenant's belongings, and it's easy to evict the tenants versus multifamily. Easy to maintain. If you can think of, 4,000 units, there might be 12 toilets total across all those units, right?
Interesting.
And then, and just ease of operations. We wanted to be able to directly operate these businesses. We didn't want to have third-party management.
I see.
We wanted to grow our team and have control in the process, so that we weren't always chasing somebody around or, using our talents to the best of our ability, and having that control and consistency no matter where we go. We're in Texas, we're in Colorado, we're in Washington, we're in the other Washington, in Washington, D.C. So we really wanted to, be able to deploy sort of anywhere and have the same consistency in our brand and the way that we run our operation. So
I see. Thank you for clarifying that. And there is so much that you said that needs to be sort of broken down at a granular level. So allow me to, maybe go step by step, Ryan, there. you said, Ryan, that you have, like a multiple state presence, right? Um, Explain us or help us understand how you manage all these properties. You are a vertically integrated company. In general, as we all know, management requires, sort of on the ground presence multiple times a day,
Sure.
or, perhaps regularly. So give us a sort of an understanding of how that works within your group.
Yeah. So the way we're structured is we have a corporate headquarters in
Hmm.
Golden, Colorado.
Hmm.
And we have about 12 people, I think, now at our corporate headquarters. And we have different departments. So we set up a capital raising department, which is what I head up with myself and Lauren. And we have a construction management department, so we can do the renovations and do maintenance requests and do kind of a facility management from the maintenance side of things. So we have a couple of people that work in that department.
Hmm.
And then we have property management. So we have a business sort of businesses, and that we have an inside corporate property manager, and we have a full-time asset manager. Then we also have administrative support to those two employees that provide us with the ability to, do administrative things for the properties.
Hmm.
So we have 3 full-time people at the corporate headquarters that oversee the property management. On the property side of things, Spartan Investment Group is an operating company.
Sure.
So we employ an additional, 15 or 18 or so employees at the property level.
Hmm.
And we buy assets that we can justify having frontline employees at. And we, manage those folks from afar through our processes. So we have revenue management software, we have cameras, we have frequent visits to the property to check up on staff, training programs, and just an overall structure that kind of supports those folks so that they can actually do the operation, lease units, and have successful businesses. So
I see. Now, going back to what you just said, Ryan, there is that you do self-management. Of course, you have employees and things like that, right? Help us understand, you must have done this analysis that if I do the third-party management, right, sort of giving out the regular day-to-day activities, you must have done that sort of pros and cons and sort of the benefits and all that, right? Give us an understanding of what sort of things you saw. It's easy for a lot of folks or listening to this or seeing this podcast understand that yes, this is what are the pros and cons within a multifamily, right? But operating a RV park or a self-storage facility is probably a lot different. Give us a sort of an overview of what are those sort of the pros and cons that go into that.
I can't think of any cons. Obviously, if you're a one-man band or you're a syndicator and you're raising capital and you just want to raise capital for a deal, totally makes sense to have property management. Or maybe that's the way you grow your company. There's really a lot of pros to having a third-party property management company, especially a good one. There's a lot of cons. There's not having good record keeping or not having alignment. But there's really not a good or bad way of going about doing it. But our philosophy was just, no property management company aligns with NOI. They all, it's all a percentage of gross income. And, just to boil down to the most simple example that I can give is alignment. And, Scott and I, just kind of serendipitously a couple of years ago, for example, we were at a property and the trees needed to be cut off the buildings to save the insurance premium. And, a property management company, what they would have done is maybe hopefully gotten 3 bids and got a landscaping crew out there and probably spent $1,000 trimming some trees back and some back and forth coordination. And we were able to just go trim the trees and save the $1,000 and take a before and after picture and got our insurance premiums reduced. So, there's, what does that mean? That means that our investors are going to get that much more cash. At the end of the day. I'm not saying that I run around, do property level stuff, but you can kind of see the synergies that sort of start piling up. When we're making decisions as a property management company, we're making bottom line decisions, not gross revenue decisions. And so I think that really aligns us with, providing the best opportunity to our investors so that we're, our alignment is to make money when the property sells with our investors, and we know that NOI it impacts that. So we wanted to have control of the quality and the process. We wanted to have control over who we hired and the culture of who we hired, and we wanted to make sure that the people we hire have alignment with our values, and that's really important. The other thing too is we operate some pretty difficult assets. So RV parks are in the middle of nowhere. They're in markets where there's subpar property management available, or there's no property management available. And, it's hard enough just to find someone to actually staff the park, let alone have the property management find somebody to manage the park, right? So, yeah. And for everybody who's kind of thinking about property management, do I do it? Do I not do it? It's a loss leader. It really doesn't make us any money. We're not looking to acquire, property management contracts with anybody. It'd be kind of a distraction from our core focus.
Sure.
It's purely just alignment. And the income that we earn off of because we do charge for property management, just because we're providing it, and we're not a property management company. We still provide for the service that we provide. And we just use that to pay our overhead at corporate for the 3 folks that are full-time doing this. So.
Sure.
Yeah.
And there's just so much good that you said. And I think my mindset is similar, where we operate our portfolio with our internal property management and construction company, although that's on the residential side. But things that you spoke of, that, having control on costs and knowing exactly that, I can do it at X. Why should I, give the bid to someone else? And also the things that, okay, I can control the schedule. I can exactly know how I can staff things up and, do things in a different order. So I appreciate it. Now, a lot of listeners will understand, Ryan, or relate to what happens on the property level on the residential and the multifamily side, right? Give us an understanding, Ryan, as to what it is, what are the daily details that go into property management in a self-storage or an RV park? I mean, gosh, you're in the middle of nowhere in the RV park, and I'm trying to understand, what sort of property management or what sort of things may be going on. So could you help us understand that?
Yeah. So I'll start with the more interesting one, which is storage. More enjoyable.
Okay.
So, multifamily, you might have a 300 unit building.
Sure.
We have a 1,100 unit facility, which, you might go, oh my God, that's so much storage. It's 180,000 square feet. So, but if you can imagine, even our most basic facility, has, a few hundred units. And, there's no power to some of the units. Some units have power, some don't, but this facility in particular doesn't have any power. This outdoor 200 unit facility. There's no water. There's no running water that goes to the facility because it doesn't have to be sprinkled. For a long time, there wasn't even internet until we bought it and we put internet on the property. So if you could imagine that these facilities can literally just be there without anybody. Now we staff them, but we have a couple facilities that don't have on-site staff. Doesn't need it. The way we set up our system, and like I said, multifamily is a great investment, and I invest passively in multifamily. And there's a lot of similarities in cost segregation and in getting deductions and the cash flow and all that's very similar.
Sure.
But storage, I think where it really peels away is when you talk about automation. You can book on a call center, you can book on your smartphone, you can pull up to the gate and get a lease executed and get a code to the gate after you pay and get right in and get into your unit. You don't even have to talk to anybody. And when you don't pay after a few days, the gate automatically locks and you can't get back in. So you pay. So the revenue management kind of integrates with the gate system. The other thing is rent collection. If they don't pay after 5, their facility gets locked. It gets double locked or overlocked. And then at 30 days, we can start the auction process to sell all their belongings for the profit that we lost during the time that they weren't paying. I see. So that I think those are the two things that really just make it different. You can't do that in multifamily. Yeah.
Sure. Now, the eviction laws are also controlled by state to state, Ryan. So are you maybe indicating, Ryan, that for self-storage, perhaps the laws are different, or are they more on a state-to-state basis, similar laws to what you would see in a multifamily?
Yeah, they're state laws, and they are very similar. I mean, there's definitely some differences, nuances, but
Mm-hmm.
generally 30 to 60 days for evictions. With COVID and the restrictions that multifamily received, we had none of those restrictions. We could raise rents, we could have auctions, we could do any of those things. Now, most operators chose not to,
Sure,
due
sure.
to the sensitivity of what was happening.
Mhm.
But, for the most part, there was no, the governor didn't declare that we couldn't evict or raise rents.
Sure, sure.
We have a couple of associations that oversee storage, and they kind of encouraged us to say, hey, you probably won't pump the brakes for a few months,
Mhm, mhm.
but there was no, official government mandate, so.
I see. Now, speaking of occupancy, Ryan, help us understand, like what sort of occupancies you are seeing, and historically how self-storage has performed. We would
Sure.
be delighted to listen to, what all you have to say.
Yeah. So occupancy nationally, I think the average has been about 94% nationwide. So very high occupancy. That's impressive given the amount of inventory that has been built over the last 10 years in storage. There's been more inventory built for storage in the last 10 years than there has its entire life cycle. So
Wow. Mhm.
it's a booming business. It's a $38 billion industry. On average, people use about 5 to 6 square feet of storage in the United States.
Mhm.
So it's very population driven. It's very highly occupied. Some markets are worse than others, but and
Mhm.
generally it's very well occupied. So our stable properties see occupancies anywhere from 93 to 98%.
Mhm.
Obviously, we're always trying to push rents.
Sure.
We
Mhm.
don't really care about occupancy more than we care about how we're economically occupied compared to what the market, beating the market. So if a storage unit's $100 a month in one market, we want to be at 105, right, and be a higher occupancy.
Mhm.
So
Mhm.
we look to have kind of the best operation and the best rents and getting more than we deserve in particular markets.
I
So
see. So now, Ryan, speaking of acquisitions, right? Again, comparing, contrasting to multifamily, we typically in a multifamily, you would say that, oh, you want to have a growing state from a population perspective, you have to have a strong household income within, sort of a close proximity of that zip code or what have you, right? And of course, you're seeing all the demographic dynamics and things like that. But on a self-storage, how do you sort of analyze the deal, or what sort of the factors you are looking at if you're looking for, like further investments to acquire?
yeah, it's a great question. So we look at population density in the 3 mile market. So
Hmm.
storage, you can't say that, hey, what's the storage like in Seattle? It depends, because some parts of Seattle could be highly saturated, and some parts of Seattle could be, there could be a significant demand.
Hmm.
People that use storage, it's they drive down the street. They don't drive an hour to their storage facility.
Sure.
If so we look at population density around in the immediate market. So the 4, 8, and 15-minute drive times.
Hmm.
We take that population and say, okay, what's the average consumption within that market, and we can kind of extract how much utilization there would be, or how much demand there would be. So
Hmm.
simple example, let's just say there's a 7 square foot demand in that market, or that immediate market, and there's 10,000 people.
Hmm.
Well, that's a 70,000 square foot demand within that market. But let's
Hmm.
say there was 3 facilities that were 50,000 square feet within that same primary. Well, you have a saturation
Hmm.
that's pretty significant, and I probably wouldn't build anything there, and I'd be skeptical about executing your business plan if it was to raise rents, or build more units or something like that. So we look for the market, facilities that have market demand. So in that 70,000 square feet of demand, maybe there wouldn't be any facilities, or very few. Or if there are facilities there, that's okay. But we would assess their occupancy and their rental rates
I
before
see.
making a decision. Yeah.
I see. So now you said a couple of things within that, Ryan, is you said that the consumption would be, let's say, like the 7 square foot per person, I believe you said, right? Or also the fact that whether there are, different facilities within that, so these are all different data points that you said, right? So if let's say I were to research, or a listener of this podcast were to research that, hey, where can I find some of this data or the competition for XYZ storage within that? Tell us some sort of metrics about where are there any websites or
Sure.
reports and things like that that the listeners can go and find this information.
Yeah, Radius Plus is a great one.
I see. So within Radius Plus, you're saying they can pretty much see everything in terms of, okay, all these different data points and things like that.
Yeah, and I really that's what really comes. That stuff right there is the most important stuff. You could have a perfectly zoned or a good facility or a great market, or somebody's trying to sell you, like a broker's trying to sell you on the market or something like that. But all that really matters is that those numbers.
Sure.
How much demand. So doing a feasibility, there are feasibility providers that would do a demand study for you. If you don't want to subscribe and pay the tens of thousands of dollars like we do in the data. But you can find that information through a feasibility study for that property, and that's what we do. We do a feasibility study on every property that we buy, so that we know what the market's doing. We use Radius. And then the other thing you want to make sure is there's no other building permits in the pipeline, because if there may be 3 existing facilities, but then there might be 4 that are permitted, ready to build. So
I see.
Yeah.
I see. Now there is this sort of dichotomy, Ryan, where you have the mom and pop self-storage owner, with a sprawling multiple acres facility, right? And now you have newer Wall Street players coming into the industry, whether it's the self-storage or I think Self America of the world. I mean, there are lots of names that go with it. I mean, they are coming up with, like high-rise
storages.
Exactly, self-storages with elevators and air conditioned places. You got automatic doors, and so you are getting that sort of the glitzy look, the millennial population appeal there, right? So given all that, right, how do you stand out, or how do you acquire some of the assets? Or should you be concerned that, oh, hey, mile down the line, there's this glitzy, self-storage that's already there, or it's going to come? Give us some context on that.
Yeah. So first of all, we own those types of facilities. So we have the older facilities, we have the newer facilities. We have the conditioned ones. We have ones with elevators. We have ones with no elevators. We have ones that are, non-climate. And, it just, it depends, right? So there are, certain markets that we're in, they're not, those glitzy storage facilities aren't coming. So we're in a lot of secondary and tertiary markets. And, how do you compare? You just have to run the numbers, right? I mean, one of those facilities might get a higher rent premium, or it might not. And you just have to see how you stack up. There is always an inherent risk that you buy a facility and then a bunch of people build later on, and you had no idea they were going to come, and they came.
Sure.
They come and they're better, and they suck up all your demand, and
Sure.
you just have to compete with them. But at the end of the day, it may not be a problem, because if there's 1 million square feet of unmet demand in a market, and somebody comes in and builds 300,000 square feet next door to you, there's still 700,000 square feet of demand.
Sure.
So it's really important to understand sort of what risk you're signing up for when you're building the storage, because you need to know how much market demand there is, and how much you can actually achieve by, when you buy your property that's existing, or maybe when you're building from the ground up. So like we're building a storage right now. We're building about 110,000 square feet, and the market has about a 300,000 square foot demand. And it's very difficult to permit in that market. So we know that we've got a 2, 3, maybe even a 4-year runway to build our facility, lease it up, before anybody would even be able to catch us in timeline on permits and building and things like that. So, we feel very safe with that.
I see.
But if if there was no barriers to entry and you had there wasn't anything you had to do, you just go down to the county and pick up your permit or whatever it is. Then you would think, okay, if I build here and the market's already sort of saturated, somebody could easily come in, and if they were dumb enough to build with no market demand, that would cause problems in the market. Then I'd look at rent per square foot. Are you already kind of running a flat tire on rent per square foot, or is the market really rich? Because if the market's really rich, you might have some room for being a differentiator in the market. Yeah, you got the ritzy, high-rise, premium product.
Sure.
But you may just be the guy that offers the not so ritzy premium product, and people that don't want to pay the extra dollar won't go to those facilities. But people that want a little bit of a discount will continue to go to yours. So there's a lot of different factors that play into that, and it's important to kind of understand your market before you make a decision to just go buy it or think that you're going to be able to get those A+ rentals when really you're a C- facility.
Sure,
you just have to be realistic with where you are. So like we're buying 4 properties right now in Texas, portfolio of 4. And it's a great example. We actually we consider ourselves about a B to a B- facility, maybe a B+ on a couple of them, but like the other ones are B-. And we're looking at the A+ facilities in our market study to kind of see where the top of the rent market goes, but we're only comparing our price increases to the average of the Bs, right?
I see.
So we're not considering the A+ in our averages. We're only averaging the Bs.
Sure.
Because you just have to be realistic with what your customers are willing to pay, or they might move to a nicer place.
I see. Good. Thank you. Thank you for that detail. And also, Ryan, while we acquire the self-storage facilities, right, like boosting the NOI and, like sort of giving the greater returns to investors is at the core of all this, right? So when you acquire these assets or when you're doing the due diligence, right, what sort of things you have done or identified in various assets that you can say that, hey, you know what, we can do these number of things and increase the sort of, the NOI, right? Give us some examples of some of the things that you may have done as far as from a amenities or improvements perspective.
So in multifamily, you're going to buy a 200 or 300 unit building and take 20 to 50 units offline at some point, and you're going to put kitchen packages in them and change the floors out, and then the rent's going to go up, right? You're going to move people in at a higher premium, and you've already done your study. You know that property down the street has got higher rents, but they also have a better product. So know that you can get a better product, right? So you can't really improve the inside of a storage unit. So if we just get our minds off that for a second, there's really nothing you can do to the unit where someone's going to go, oh, well, like I really like these corrugated interior metal walls,
That's why I asked that question. I'm like, what are the different things you typically do,
Yeah. So getting that kind of out of the way. So we look for properties that are mismanaged. So, I'll give you a great example of one. So we bought a property in September of last year. And for whatever reason, the owner just let the thing go and just slam into the ground and burst into flames. There was 209 units, and the property was falling apart. It was rusted. The doors were dinged and dented, and the locks were broken, and some of the doors didn't even work, and people had piled up trash in units, and nobody was enforcing leases. A lot of tenants didn't have leases. There was abandoned boats there. I think we used about 24 dumpsters or something to haul off all the trash.
All the crap.
And it was 14% occupied economically.
Wow.
So we looked at this and we went, okay, we can buy this for $22 a square foot to include the cost of the land, which is essentially, you can't even build anything for $22 a square foot, let alone the time and the interest reserves needed to get, to kind of get through construction and the headache of permits and construction management. So we bought it at $22 a square foot. I think most recently the property is almost 60% occupied in about 4 or 5 months. And what we did, we come in there and we added a website. There was no website. We listed on Google. we added revenue management. We added a call center. We added cameras. We repainted the entire facility. We repaired all the sheet metal. We replaced all the door springs. We replaced the doors. We put concrete in some units. We repaved the drive aisles. We redid the fencing. We did the marketing. We put in a 30-foot sign pole so people could actually see us on the road. We put billboards up around town to get lease ups. We advertised in the local community by sending out 10,000 letters to local businesses and people. We, hired a staff person there to, kind of mitigate lease up. We repositioned the gate because this was mostly a boat storage facility. Because people were turning off the main road, the gate wasn't set far enough back. So when you were looking to turn into the facility, your boat was hanging out on the road. Just many, many different things. We added the ability to do, we're rolling this out soon, RV storage at the property. So we just put a lot of polish on the property, and we're just ease of booking. It is easy for the customer to go and book our properties. And that is the number one differentiator. Some of these mom and pop properties in the middle of nowhere, you call and you get a personal cell phone, and maybe the guy answers, maybe he doesn't, maybe he gets back to you, maybe he doesn't, I don't know. But basically, someone picks up the phone when you call our facilities, and we convert. I believe it's something like more than 50% of the people that call us. So if you call or inquire, there's a 50% chance you're going to get converted. And we do SEO, we do Google AdWords, we do social media, all platforms, to make sure we really drive that. And, we assess the property. We say, hey, we're buying this at $22 a square foot. We do our market study and we say, okay, we might be getting, a $15, the property may be getting $12 a month rents, or $12 a square foot rents. But we look at the market and it's $18 a square foot. And the reason why this place is A, empty, and B, not getting the rents is because they're just absent. So that's a really extreme example. A little less extreme would be a stabilized property that's running pretty well, but the owner is just not pushing the market. So everybody has, 20, 30, 40% higher rents, and we can come in and be more efficient, be better on marketing. So that, if we do raise rents and we do cause disruptions with our customers, there's good marketing to bring new ones in.
Sure.
And the other big way we add value is we build more units. So typically we find properties, like right now we just broke ground on building another 40,000 square feet on a property. So we bought the property with 80,000 square feet, and we're adding about, 250 more units. And the market study said you could do that. So, and reasonably expect to get the customers. So we add more units, and we make operations more efficient.
Got it. Thank you. Thank you for all that detail. Now, in that example that you shared, Ryan, where you had 14% occupancy and things like that, how do you go about financing such a deal?
We bought that one all cash.
Got it.
So, yeah. So, when you kind of talk, kind of get to the brass tacks of the numbers. So we picked that property up for about $1.35 million, something like that. We paid all cash. And so when you get into a lease up deal, where it's basically empty, for all intents and purposes, a little bit of revenue.
Sure.
You got to put together OpEx losses, because you're going to lose money for a while.
Sure.
And then you've got to tranche your capital improvement projects.
Right.
And then you got to tranche your kind of operating reserves.
Right.
And then make sure you have enough runway based on your lease up expectations to get to where you want to go. So we started off at 14% economic, and we got it up to about 60. And we planned to lease up at about 5 units a month. So we're hitting our targets on the lease up rate, and we're giving ourselves cushion to do that. But really, we could have gone and messed around with a loan, but in that case, the investors are getting somewhere close to 18-19% annualized, and the that deal just we could make it work with cash, because if you take the NOI of a property like that and you value it, it's probably going to get valued at around 6 to a 6.5% cap rate. That property is a $4 million stabilized property. So, we can lease it up. We'll probably get that thing up close to 90% economic by maybe the end of 2021, or, in the next 6 to 12 months. And and you can make those numbers work with your investors.
Mm-hmm.
And you tell the investors in that particular deal, we would not have any cash flow, right? We will no cash flow for 5 or 6 months or something like that.
Mm-hmm. Mm-hmm.
Yeah, and we don't do return of capital. It's just, any profits that are made in distributable cash, would send. So in that case, I mean, we didn't have a loan. Now on these stable properties, yeah, we'd finance it, and then we would just get aggressive with the operational rental increases, and then we eventually do some kind of construction component.
Right.
The RV parks, we bought cash. So, same thing. Those were turnaround plays where we had to redevelop pretty much the entire park. And those were operating at a 40 cap.
Wow.
On purchase. Yeah. So now risky. Those are risky deals, but they operate at very high cap rates, and they're very high. They're the highest cash flow on any deal I've ever seen.
Right,
so,
right.
Yeah.
Now I want to turn that detail over there, Ryan. Is you said you add units, or you look for that component where you can add additional units and stuff like that. Is that sort of the secret sauce or the linchpin within your underwriting, that you want to look for that? Because at the end of the day, as we all know, as all syndicators for acquiring all the assets, right, you are looking for that some punch on the NOI, whichever way you can bring, right, whether you're improving operations or adding these different amenities, or as you indicated, like doing the the new construction. So is that something you always look for, that you want to add some units? And I want to also ask you a follow-up there, is that what does that build process looks like from a let's say a permits perspective, and sort of that development runway?
Yeah, so it doesn't have to have added units. So the turnaround play that I talked about just a minute ago, there was no additional units in that, really.
Mm-hmm.
Maybe we might get 5 or 6 RV spots or something, but does it have to? Generally, we like it to, because I think that's really where we separate ourselves, is we have development experience from the residential space.
Sure. Mm-hmm.
And I think that makes us different, because a lot of operators don't have development experience and can't really get their hands dirty with really adding on additional units.
Mm-hmm.
And I think we can really, get some nice returns out of that ability to do that. But it doesn't have to answer your question. It just has to be enough of a value play, and that's why we like having our own property management company, because we know we can turn these properties around now. I mean, we've gone through this, we have a marketing checklist, we have an OpEx checklist, we have a CapEx. I mean, we have everything kind of dialed in. So we know we can get a lot of value on those heavy value add turnaround stuff. So we like that. What does it look like to build? It depends. And I know that answer sucks, but it really does depend. If it's a single story, you're talking about slab on grade metal buildings, standing seam roofs. You may have an interior corridor hallway with some HVAC, some basic HVAC. If it's a multi-story construction, still, you're not getting that complicated until you get above 3 levels. 3-level construction, you can do light gauge steel for your structural steel. You can do pretty much the same foundation, slab on grade foundation. There is some, foundational components to it that are a little bit different. But when you go vertical, you actually start saving money, because, you have the elevator, that gets you past the 2nd floor. But, when you add that 3rd floor on, it's really cheap. The floor pans, you don't have another foundation, you don't have another roof, you don't have additional walls, doors, access. You lose efficiency because you have interior corridor hallways and you have stairwells. But really, the permitting process is just like anything else, except you have a lot less components, when we do the MEPs or the mechanical, electrical, plumbing on those, it's usually deferred submittal. It's a basic, we have, like I said, we have units, storage facilities like that, where there's not even any lights in the interior units. They're just in the hall. And, again, there's not extensive plumbing, because there's not extensive, bathrooms or things like that. There's not a water heater in every unit. There's not a bathroom in every unit. There's nothing really in every unit.
Right.
Fire code requires us, to do fire suppression. And, could be a wet or a dry system, and that could add to costs, and, permits through the fire department, and then fire marshal could be more, but yeah, it just depends. It could be very basic, $40 a square foot slab on grade, single story. Or you could be developing a site that is, you have a huge haul off for your dirt, and you're talking, $110 a square foot, right? So
Right.
it just depends. And, people always ask me, what's it cost to build storage? And I'm like, man, I do not like answering that question
It
because
depends on the project, I guess.
yeah, I mean, if you've got a, 0% grade and, the sewer lines up and you have no wetlands, no deforestation, you have no export, okay, yeah, it could be $40 a square foot. But if you've got a property with wetlands or, significant trees or, that you've got to do a lot of grading on, I mean, your civil bill could be in the millions. So
Sure.
it just depends, and that from construction.
Absolutely. Now, turning our attention, Ryan, to some RV park discussion. Give us some idea of like, how much of assets you have in RV park, or how is that asset class keeps you excited?
Yeah, so we have about 250 operating pads right now, and we have 217 pads that we're building. So 400, 500-ish kind of in progress. And the RV parks are great. They're really not that, they kind of fall in line with our philosophy: easy to manage, easy to evict, easy to maintain. You're offering a mobile home park where people can drive in and drive out. And generally, you got four different types of RV parks. You got the destination ones that like the theme parks. You've got campgrounds off the side of the highway that you can do a quick overnight stay. Then you've got campgrounds like, hey, let's go camping this weekend, right? And then you have places where people live. Well, ours are where people live. And, there's different qualities within each of those examples I gave, like luxury, things like that. But generally, we are providing workforce housing in Texas. And, those RV, we're doing a water we're doing pedestals, water, electric, sewer. And, we provide a couple of bathrooms and showers for people that desire, a dog run area. We sell propane at the front of the park as a convenience. One of the parks, we have a convenience store, a laundry room that we operate, and we're providing, the tenants stay anywhere from 4 months to 4 years.
Wow.
And as little as a month. It's a month-to-month lease.
I see.
Yeah, and there's some overnight stays here and there, but really we're focused on the long-term tenant. Running it's great. I mean, we don't have to maintain much of anything. We have an office and we have, the utilities and the infrastructure, but really there's nothing to maintain. We don't own any of the RVs. And we're not responsible for any of the maintenance on the RVs. And, the expense ratio is pretty good.
Got it. What expense ratio it operates at, by the way?
I think it's like about 32%.
Wow.
Yeah.
That's pretty modest.
And that's payroll too. So.
Wow.
And we take all the utility expenses. So if you took the utility expenses out, it would drop, probably into the mid to high 20s.
Wow.
So.
Wow. And is there an opportunity to bill back the residents any of the utility expenses?
You could. It depends on your market. So, it depends on what everybody's doing. So in our markets, generally people are just paying, we're covering the cost.
Everything is included. Got it.
Yeah. Sometimes the parks will do like a premium in the summer, where they'll raise rents in the summer to cover the extra cost of water. And the trailers running their air conditioning units. But, it's generally it's kind of what the market demands.
Got it. Thank you. I know it's we are running at the top of the hour now, but I want to turn attention to the investor appetite. You at your company lead the, sort of the investor relations and the capital raising as well. So give us some idea about how much is the investor appetite for this asset class, and what are you sort of hearing from all the other passive investors?
Storage is the place to be right now, and money is flooding in. In fact, it's going to make our disposition really nice at some point, but our buying, it's difficult because there's disruption in the market right now, and what happens when there's disruption is people use storage.
Absolutely.
Because they're getting relocated, they're moving their jobs, they're downsizing, they're getting divorced, unfortunately, or there's some type of disruption in life. And storage events are because of life events. And so, right now we have heavy competition for projects, and we have very hungry investor demand to be in self-storage.
I see.
So, yeah.
Got it. And from a returns perspective, Ryan, typically, give us a sense of, I know every project is typically different, but in general, like, are there, the limited general partnership share, or, if you have any preferred returns and things like that, give us an understanding of, in general, what sort of your model looks like.
We're usually like 8% pref, anywhere from 6 to 10% pref, usually about 8% pref, which obviously isn't a return. It's just a preference
Sure.
on the split. And then the splits are anywhere from 50-50 to 80-20, just depends. And, I would say the returns are very comparable to multifamily. If you're doing heavy multifamily value add, you would expect in multifamily that to be in the 20s, right?
Sure.
If you're doing, right down the fairway, B+ building in a great market, you would expect a return to match that, maybe lower teens. If you're doing kind of something in the middle, you get something in the middle. But generally, because I invest in multifamily passively,
sure,
and I don't really see much difference in between the two asset classes, to be honest, in the cost segregation side of the house or in the cash flow side of the house.
I see. So. Now, Ryan, one last question here is, knowing multifamily right now, right? We know the push or the general demographic shift moving towards, let's say, the southern states, whether that's the Georgia or, let's say Florida, Texas, Alabama, or, Vegas in general, right? We call the Sun Belt states of sorts. But knowing the self-storage class, asset class that we are talking, or even the, the more manufactured housing and things like that, right? It seems to me that there isn't any push as such. It's more based on, the whole area is wide open. It just depends on whether the assets make sense to acquire. Would that be a correct statement?
It would be. There's some markets. So we actually publish all the markets. So multifamily, there's millions and millions and millions of multifamily buildings.
Sure.
Self-storage, there's 50,000 in the United States.
Gotcha.
And probably 25,000 you can just write off as middle of nowhere. You don't want them assets, right? Like they're just so off the beaten path, you wouldn't want to mess with it. Maybe less than that, but generally storage. So we publish the markets that we look in. So some people are multifamily operators. They can stay in one market, right? Because there's enough deal flow to stay in that market.
Sure.
Storage, you kind of got to get out there a little bit more because you need deal flow that makes sense with your criteria. So we actually publish the markets that we look in that we perceive to be the best markets in the US. And that's on our website. So on Spartan-investors.com, we put at the bottom, we publish the 154 markets that we look in, and it's population growth, job growth, rent per square foot. It's, job migration. It's all the things that create people, essentially, because people are what drive storage demand.
Sure.
So, for example, Ohio, Cleveland, declining population, Columbus, growing population. So we look in Columbus, we don't look in Cleveland, so
I see
that, as a small example, Oklahoma, no offense to Oklahomans or whatever you want to call them. The rent per square foot in the entire state is below $6 a square foot. So we don't even bother looking in Oklahoma because we can't add value by building additional units there because we can't justify the new construction cost with the rent that we would get when we built.
Sure, the numbers don't work.
Exact numbers don't work.
Right.
So then we don't look in California because it's hard to develop there.
Sure.
Hawaii is too far away from us. I don't think we look in Alaska, but generally the Pacific Northwest is a great place to go. Arizona, Texas, the Florida states, the Carolinas, just all the things that you mentioned, great places. But again, those are generalized statements that really have no weight because
sure.
I could show you a market in Seattle that's awful, but I can then show you a market where there's tons of demand. And it's getting more difficult to find those like niche main streets that have that sufficient demand. So yeah, it's definitely, localized industry. It's a 3-mile business for sure.
Right. So there's, I think, if I were to, I think, summarize it, you're saying that there is definitely the demand drivers, the demographic drivers that we all look for in general, but still at the same time, you still have to kind of see the one-offs, or if there is let's say high density infill type of self-storage in some market, that can still be an opportunity given the numbers and the all the asset specific details work. Would that be correct, right?
Absolutely. Yeah.
Got it. Thank you. It's been a pleasure, Ryan. Here, I know
Yeah. Thank you.
we definitely have pushed sort of the time limit on this episode, but it's been a great conversation. I appreciate it. Please share with our listeners, how they can find you and learn more about your company and various projects.
Yeah. So my email is Ryan, RYAN, at Spartan-investors.com, or you can just go to our website, Spartan-investors.com, and everything's on there, our portfolio and all of our contact information too. So
awesome. Thank you.
Yeah,
and listeners of the podcast can also find us our podcast at premiumcashflow.com, and as well as all the different social media channels. And if you are a passive investor, you want to invest in, please head on to our website. There's a link for Invest With Us. We are always happy to get on a short phone call and discuss your investment goals, and we can certainly help you with any other projects. And of course, expert guests like Ryan are always there to share their expert knowledge. So all the podcast episodes are also published on the website. So it's been a pleasure, Ryan. Thank you for your time, and thanks for coming on.
Thank you so much for your time. Appreciate it.
Sure.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.